Super Microcomputer Inc. finished its last active trading session on Friday, May 15, 2026, closing at exactly $31.04 per share, marking a sharp intraday decline of 6.02% on massive trading volume of over 27 million shares. While a 6% drop in a single day typically sends retail investors panicking toward the exits, the real story unfolding behind the scenes is that large institutional players are using this exact volatility to accumulate massive blocks of shares completely out of sight from the public eye. The common belief holding down the stock right now is that the company is permanently broken, weighed down by compressed gross margins, a string of highly publicized export control scandals, and an ongoing federal probe that has scared off conservative capital. But if you look deeper at the corporate plumbing, you see a business that is completely reinventing itself from a simple hardware assembler into a full-scale provider of liquid-cooled data center architecture. The expectation was that the company would bleed out as large semiconductor firms began offering pre-assembled racks directly to hyperscalers, but the reality is that the backlog for their high-density cooling systems has hit record highs, creating a profound disconnect between the stock price and the underlying operational momentum. When looking at recent stock movement, the daily swings tell a story of intense tug-of-war between short-term momentum traders and long-term value allocators. Over the past month, the stock has actually put up a net positive return of more than 20%, showing that the recent single-day drop is more of an expected cooling-off period after a massive post-earnings surge rather than a fundamental breakdown. In the first week of May, the shares skyrocketed nearly 25% in a single session after the company reported a surprise recovery in its gross margins, which climbed back up toward 10%. That sudden squeeze forced short sellers to cover frantically, driving the daily volume well above historical averages. Institutional activity has taken a fascinating turn over the past 2 quarters, with heavyweights quietly adjusting their positions across major retail and professional platforms. Investors utilizing sophisticated online investing tools such as Schwab Intelligent Portfolios or a standard individual brokerage account have seen the stock bounce around its 50-day and 200-day moving averages, signaling an incredibly volatile but consolidative technical setup. Whether someone is using standard investing sites, managing their own capital through self-investing, or setting up a long-term retirement strategy via Fidelity IRAs, understanding this institutional footprint is vital. Recent regulatory filings show that while retail interest on platforms like the Robinhood app has experienced a temporary dip, massive global entities are maintaining their stakes. For instance, global managers are holding millions of shares because they recognize that the valuation, trading at a forward price-to-earnings multiple of under 10, is severely discounted compared to the broader tech sector. The sharp drop to $31.04 is primarily a reaction to macroeconomic pressures and structural constraints rather than a lack of demand. During the last earnings cycle, the headline numbers revealed that revenue more than doubled year over year to over $10 billion. However, the market threw a tantrum because Wall Street was expecting closer to $12 billion. The reason for the shortfall was not a lack of customers buying server racks. It was a severe shortage of critical data center components and advanced graphics processing units. This supply chain bottleneck forced the company to push billions of dollars in recognized revenue into upcoming quarters, creating an artificial lag in financial performance. To counter this, management aggressively built up its inventory to over $11 billion, which led to a substantial negative operating cash flow of $6.6 billion. The market reacts to negative cash flow with immediate selling, but smart money look at that inventory surge and see a coiled spring of future revenue waiting to be unlocked once site readiness clears up. To truly understand why the stock is trading where it is, we have to look at what the business actually does under the hood. Super Microcomputer designs and builds high-performance server solutions, specializing in modular architecture for enterprise data centers, cloud computing, and massive artificial intelligence training clusters. Their core business model relies on speed to market and deep engineering integration with primary chip designers. When a company wants to deploy thousands of advanced processors, they don't just buy chips. They need complex power shelves, battery backup systems, networking equipment, and intricate cooling infrastructure to keep the machines from melting. The company has carved out a distinct niche by mastering direct liquid cooling technology, which reduces electricity consumption for data centers by up to 40%. This side of the business is growing rapidly, with production capacity on track to scale to over 6,000 racks per month. Historically, this business was highly profitable, boasting gross margins well above 15%. However, over the past 2 years, intense competition from legacy players like Dell Technologies and Hewlett-Packard Enterprise, combined with soaring component costs, crushed those margins down to single digits. The legacy business model was heavily reliant on hardware sales, but management is actively turning the ship around by building a highly profitable software ecosystem. Their proprietary server management suites, including SuperCloud Composer, saw bookings jump to $46 million in the recent quarter, moving away from a single-product hardware model toward a high-margin recurring revenue stream. Comment below how many shares of Super Microcomputer you currently hold in your portfolio right now, and let me know if you are buying this recent dip or waiting for more clarity on their regulatory filings.
Looking at the capital landscape, the way people invest in these volatile tech stocks has changed dramatically. Investors who prefer a hands-off automated approach often find exposure through vehicles like Fidelity ETFs or specific algorithmic models inside an intelligent portfolio. On the other hand, active traders looking for real-time execution and low international transaction costs tend to route their volume through the Interactive Brokers platform, especially when playing the highly liquid options market on tech names. Even younger retail traders executing smaller trades via Robinhood fractional shares or taking advantage of the Robinhood cash management features are heavily involved in the daily liquidity of this ticker. The availability of deep educational resources and advanced technical charts on the Fidelity trading platform has allowed everyday investors to analyze these complex corporate turnarounds with the same precision as institutional desks. The future outlook for the company is a classic case of high risk balanced against an extraordinary potential reward, completely dependent on the tension between market expectations and operational reality. In the bull case scenario, the primary catalyst is the relentless build-out of global data centers. The company is currently shipping high-volume server systems built around the newest architectures from major semiconductor designers, and they are already preparing infrastructure for next-generation platforms. If the company successfully scales its liquid cooling manufacturing to full capacity, gross margins will continue their steady march back toward 12%, which would easily trigger a massive upward re-rating of the stock. Furthermore, as the massive inventory backlog is delivered to clients over the next 12 months, the current deeply negative free cash flow will flip aggressively into the positive, erasing the primary bear argument used by short sellers. Conversely, the bear case cannot be ignored, as the company faces structural risks that keep conservative wealth managers hesitant to buy in bulk. Their heavy reliance on a single tech sector tailwind means that any macro slowdown in corporate capital expenditure would immediately hit their bottom line. Competition is intensifying daily, and if major chip manufacturers continue to develop their own pre-configured rack solutions, the company could see its role as a middleman further marginalized. There is also the lingering dark cloud of regulatory compliance and past accounting adjustments. Until the company completely clears its legal hurdles and establishes a pristine track record of transparent financial reporting, the stock will likely continue to trade at a significant discount to its peers, regardless of how fast the top-line revenue grows. When you weigh the entire situation, the stark contrast between expectation and reality becomes the defining factor for the stock. The market is pricing the company as if it is a low-margin commodity hardware seller trapped in a web of permanent structural dysfunction and intensifying competition. The reality, however, points to an agile engineering firm that occupies a critical checkpoint in global computing infrastructure, holding record order backlogs and rapidly scaling a highly profitable software division. For investors managing their own capital through self-investing, looking for expert investment help, or utilizing specialized tools like SoFi Robo-Advisor, this stock represents a volatile battlefield where the final victor will be determined by execution rather than narrative. The massive discount in valuation offers a massive margin of safety for those who believe the operational turnaround is real, but the journey forward will undoubtedly be marked by the same violent daily swings that we witnessed in the latest trading session. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.